Joining us at Capstone Coffee Conversation. My name is Ryan Skogstad. I'm joined by Brian Felshaw this morning. We thought that halfway through the year of 2024, let's do a market recap. We'll just kind of give some thoughts. Brian is going to touch on some of where the stock market indices are at 6 months through the year. We'll talk with a little bit of thoughts on, what has driven that and where that lands today. We'll talk about some other areas of the market, international and what have you, and kind of where those markets stand today. I'll cover interest rates and what bonds are doing as we enter the halfway point. Pass it back to Brian, and we'll do some alternative investments, things different than stocks and bonds. And then we'll finalize it, we'll close it, and I will just give some thoughts on the next 6 months and what are we liking and where do we see ourselves and things to look out for. As always, though, as we're talking, if you can send a message to the host or chat to the host if you have a question, that's what we'd love to talk about, is things that are on your mind. So please just send a note at any time. And then when we close it out in about 15, 20 minutes, then we will try to hit on any of those questions. So, Brian, you want to kick us off?
Let's jump right in. So starting with the big US large cap indexes, one of the big stories of the year, the S&P 500 is up 16.8%. Pretty big year so far. More commentary on that coming soon. The Dow Jones Industrial Average, a little bit more value heavy index, up 4.4%. And the NASDAQ, which is a little more technology growth heavy, up 21.4%. So pretty darn good year for US large cap markets so far, right?
Yeah, and I'm going to dissect that a little bit, right? A lot of times we paint the stock market with one big broad brush and say, well, the market's up this or down that. But I'm going to drill down a little bit into what is making up those returns so far this year. So just to give a little bit of clarity on some of the numbers underneath. The equal weight index. So if you own one of everything in the stock market of the S&P 500, so all 500 companies equally, your return is 5% on the year. And if you think about, well, a 5% return, that's not that good. It's actually average, right? If you think about the S&P 500 over time, gets about 10%, maybe 11%, depending on the timeline that you're looking at historically. 5% through half of the year is on pace for about a 10% return. So the equal weight index, owning one of everything equally, is giving you about a 5% return thus far. The top 7 stocks, a lot of times we refer to those as the Magnificent Seven, if you've heard that term. Those top 7 stocks make up companies like NVIDIA, Apple, Amazon, Microsoft, Tesla, Google, and am I forgetting one? It might be. Yeah, anyway, those top 7 stocks are up 33% so far this year. So you look at, the other 493 are up about 5. Those top 7 are up about 33. The S&P 500 is a market-weighted index. So it doesn't hold one of everything equally. The more valuable a company is, the more it holds of those companies. So the top 3 stocks in the S&P 500 make up more than 20% of the index today. And they're all tech names. So what we're seeing is what used to be a very diversified index. The S&P 500 used to be pretty darn diversified. You had lots of different areas of the economy, all moving different directions at different times. Today, the diversification is getting reduced, right? A lot of your money in the S&P 500, if you're just owning it passively, is going into one area of the economy. And when things go really well, which so far, the tech area has done very well in the S&P 500, then that works out well. But when things don't, then sometimes I'd be on the flip side of that. But so far, the equal weight index is up about 5, but 7 companies are really carrying the bulk of that return.
Just to add some extra little statistics to that, the average weight of each company in the S&P 500 is 0.2%. NVIDIA, which is the big artificial intelligence story of the year, January of 2023, it was 1.4% of the S&P 500. So already bigger than the average. And fast forward to today, a year and a half later, it's now 6.5% of the S&P 500. So those top big companies, specifically that one, NVIDIA, have really carried a lot of the market. Yeah, and I think that begs a lot of questions about what's going on with our economy, and we'll talk more on that later. Moving a little bit more towards the mid and small cap areas, we look at the Russell 2000 as kind of a measure of that. It's up 0.6% for the year. So pretty flat year for all of those smaller and mid-sized companies. Ryan and I were just talking beforehand. If you zoom out to October of last year, they had a big rally in the fourth quarter on the expectations that we might get a cut on interest rates. And so that would be a boon potentially for small and mid-sized companies that rely more on debt and interest rates being a big factor. But with that interest rate cut being pushed out a little bit further, potentially that's impacted their return being a little bit more flat for the year. On top of that, international, looking at the rest of the world, we use an acronym, EAFE, for Europe, Australasia, and the Far East to measure the international markets, up 7.4% year to date, very quietly outperforming much of the US market year to date. Emerging markets outside of that kind of big zone, the EAFE zone, up 9.3 as well. So pretty good returns for the international markets so far this year.
International markets have started to see rate cuts, right? Where we're still holding the line on not seeing our first rate cut yet in the US. International markets, the central banks have started lowering rates. So they're starting to get a tick up in their average stock faster than a tick up in the US average stock so far this year. As far as fixed incomes is concerned, safe money, I've said it today, safe money is making money today, right? So it's not quite as high as we were in October of last year. Interest rates saw a peak. We're not quite at that peak, so not as attractive as they were maybe in the fourth quarter of last year, but bonds are still at good interest rates, what I would call maybe kind of fair interest rates. We're not getting overpaid on bonds, but we aren't avoiding them either, okay? So as I look at, I'll just give you a couple of little stats. The 10-year treasury today is paying 4.3%, and that's just treasuries. Think about if you add in some corporates and things of that nature, then your return goes a little higher with slightly more risk if you add corporate bonds. But the 10-year treasury is at 4.3. If you look at a corporate and government bond index, so the AG is a kind of a mixture of corporates and treasuries, it's paying 4.7% today. The 2-year treasury is paying 4.7. So 2 years paying 4.7, the 10 years paying 4.3. And you might think, well, usually if I invest my money for longer and lock it up longer, I should get a higher return. And you are right. However, over the last couple of years, that has been upside down. And you're getting paid more to hold fixed income on the short end of the curve, 4.7 for a 2-year treasury. You're getting paid a little bit less, 4.3 on a 10-year treasury. So we are still of the mindset of make sure that we're staying somewhat short on that duration because the Fed is holding that interest rate high on the short end. That's what they control. So that 2-year treasury is still maintaining a higher interest rate margin than the longer term bond. Mortgages today are about 7%. They've kind of been waffling around the high 6s to low 7s. That's making it somewhat difficult still for, we see a lot of people buying or selling homes, and that's still a challenge, and that hasn't changed much, kind of the same story there. And so today, I kind of said it when I started the little fixed income piece, safe money's making money today. There's nothing wrong with earning a good return in 4.5 to 6.5%, depending on type or duration, without a lot of risk.
Looking at some of the alternative sectors of the economy, other types of investments, we have Bitcoin being a big story this year, up 64.2% so far year to date. It's hovering around 60,000 per coin. It's been hovering between 60 and 70,000 for the last handful of months, 4 or 5 months. It is 17.7% off its all-time high. Back on March 13th, that high was $77,000 per coin. That's an interesting story to follow. Real estate continues to be fairly soft. Real estate's a big sector. There's everything from server farms to commercial to single family homes. But as Ryan said, with rates being higher, that's continued to kind of put a lid on real estate being kind of soft. The inflation rate year to date, we're looking at 3.27%. It's been hovering around that 3.1 to 3.5 over the last 6 months. That's still down quite a bit from its high of 9% back in summer of 2022, but not quite down to that 2% long-term average that the Fed likes to see for the US. One big story as well that we're watching is the US unemployment rate started the year at 3.7, and it's ticked up a little bit to 4.1%. And I think that's a good segue to discuss what do we expect for the second half of the year.
Yeah. So over the next few months, the things that we're looking at, the market has done pretty darn well today. If we look at in total, the S&P 500, it is at a fairly expensive price point for an entry point if you're buying it today. And again, a lot of that has been driven up because of the tech side of the index. So we're trying to be very careful in what types of areas we're owning in the market, but there's been a lot of divergence, as we kind of talked about at the beginning, a lot of divergence in returns. Some things have done very well. The good news is that nothing's broken. There's nothing in the portfolios, whether it's small cap, international, bonds, big cap US, everything has been meh, flat-ish to really good. There's been nothing though that we've seen that is making us into forced changes, right? And so that's the healthiness, I guess, is at least everything is behaving. But the one thing I kind of keep cautioning people on, concentration is the fastest or easiest, quickest way to make a lot of money, but being over too concentrated in any certain type of position is also the fastest way to lose money. All right. And so we have to be very careful as we start to hit price points in the S&P 500 that are pretty rich, that we aren't getting overextended. So we're trying to be very diversified across all different holdings in this interest rate environment where certain areas of the market are also getting fairly frothy. And when markets get to a point where they are slightly expensive, we have to understand that if stocks are expensive relative to historical norms, then our expectation of future returns probably needs to be a little muted, right? If we're buying stocks cheap, historically, then over time, then you actually might get a little bit better than average return. But if you're buying expensive stocks, then you should expect a less than average return. So we're trying to pick areas of the market that are not overextended and make sure we're very diversified. We're still hoping we see a rate cut this year, and this has been a challenge. The Fed came out, I think the fourth quarter of last year, and said 3. They haven't done 1 yet, and we're in July, right? And so we're running a little bit out of time for them to do 3 rate cuts this year. Market's predicting about 1.5 rate cuts. So that would be nice. That would really help certain areas of the market. So we'll see where we come on that. We have the election coming up in a few months, and yes, there will be a lot of noise. I wouldn't be surprised to see the markets kind of wait for the election, and take a breather and not do much over the next few months. And then we see where we go from there. So that will definitely be causing maybe some volatility, but stock and bond markets aren't afraid of elections. We are not either. Where do rates go? I wouldn't be surprised if the Fed does start to lower rates. That will have more of an influence on the short end of the curve than the long end of the curve. Right? Remember, we have that inverted yield curve where the short's pretty high and the long is less than the short end. The Fed starts to lower rates. I wouldn't be surprised to see that short end lower and maybe come par with the long end. And maybe at some point we get back to normal, because normal is longer term rates pay you more than shorter term rates. And we've been away from that for a while. And then finally, we've been waiting for maybe a soft landing, or are we going to have a recession? And the economy keeps chugging along and doing just fine. There's enough continued growth that the Fed's been holding off on rate cuts. The good news is we have a little bit of a backstop. And if the economy does start to falter, the Fed does have ample room to start to lower rate cuts, which could kickstart the economy again and get it going in the positive direction. So if we do start to see some pullbacks, the Fed's waiting for that, and then we can have some rate cuts at that time, which would be helpful. That will close out our comments for the morning. So Moesha, we're going to turn it over to you and see if you have any questions.
So I got one. Should we be more aggressive or more conservative heading into the second half of 2024?
I'll speak to that. So I think first off, you always have to put that in context of what's your life stage, what are your goals with your investments, what type of investments are you trying to build, and what are you trying to accomplish ultimately? I think ultimately, right now, with so many events that we're looking forward to, like a possible rate cut and things like that, we've been relatively neutral across the board, not trying to put our allocation more towards one area or another, trying to take a big risk or a strategic move, but really trying to have our fingers in everything because there's a lot of different possibilities of how things could play out. Um, there's an old saying that when you don't know where your risks are going to come from, you use diversification. When you do know where your risks are coming from, you can hedge directly against those. Right now, I'd say with so many different things of how this could play out, I think diversification is the answer. The first part of that saying. So, not to say that we should be more aggressive or more conservative. I think your life stage and your goal really dictates that. We're fairly neutral, all things considered. Yeah, good question.
And neutral can sound boring, but it's a purposeful choice sometimes when you're getting paid good for fixed income and certain areas of the markets look certain ways. Sometimes being neutral is a good spot.
Yeah. Got one more. When will AI have a more influential effect on the stock market?
I think it's having a pretty good effect right now. Yeah, it is. It is the one story this year. Like we kind of went through a lot of different pieces up here. Average stock is having an average return so far. International slightly better than average. EM a little bit better, but a lot of things are doing fairly average this year or close to it. The AI story is the one thing that has driven a handful of company names up quite a bit, which has kind of drugged the whole index up as well. So AI is having its fingerprint on the market so far this year and a lot of last year too. And that was what led us out of the 2022 big, huge pullback. 2022 was really awful if we remember. Well, AI really kickstarted a recovery in 2023, and that was the major reason.
Yeah, great. Good question.
Well, thank you for joining us. We always appreciate doing these with you. As always, if you have further questions, want follow-ups, or how does this affect me personally, reach out to your advisor. We'd love to chat with you about that. We just like to get this message out on a monthly basis and kind of talk to people about what we see as important in the markets. And so thanks for joining us. We'll see you again next month.